The great financial crisis underscored that distress in large banks can spill over to the broader financial system. Focusing on such banks, especially those designated as global systemically important, post-crisis reforms have striven to improve their resilience and also create incentives to reduce their systemic importance. Our special feature assesses whether these objectives are being met. Overall, our findings are generally encouraging, with some nuances. Let's start with resilience, which we estimate using banks' probability of distress, or PDs. We find that average PDs have come down since the crisis. In fact, they have dropped lower relative to the pre-crisis levels. Moreover, G-SIBs PDs are lower than that of other large banks as intended by regulation. Several factors have contributed to this decline, with higher capital ratios having played the major role. Although weak profitability is an opposing force for many G-SIBs.
So next, we turn to systemic importance. To measure this, we use the official G-SIB scores, which combine various indicators of market presence of these banks to measure their systemic importance. We find that G-SIBs have become systemically less important relative to non-G-SIBs, primarily on the back of their lower relative size, interconnectedness, and complexity. Zooming in, we find that while the top G-SIBs have reduced their scores, most others have increased these scores in recent years. First, we provide a more inclusive estimate of banks' resilience by combining various opposing risk factors into a single PD model. Second, we also make inroads in teasing out the role of the G-SIB framework in these banks' adjustments. Post-crisis reforms have put in a lot of effort in reducing the risks posed by G-SIBs. Assessing how they've functioned and whether their objectives have been met is crucial in guiding policy design.